Good morning, Shree. Thank you for joining me as we conduct our first SVN Capital Q&A session. We're delighted to have had some great questions come in from some of our partners, and we look forward to providing this update. So before we jump into that, there has been a lot happening, undoubtedly, since you shared your thoughts and your observations on the portfolio in your year-end letter. We've seen some dramatic shifts and volatility in the markets around the world. How is this, if at all, affecting your investment process?
Sure. Yeah, thanks to the people who wrote in some of the questions. Looks like there are some very interesting observations, and look forward to providing this video update. So as we record this in early March 22, the war in Ukraine is at the front and center of everybody's mind. I'm reminded of a famous quote by Winston Churchill: "War is mainly a catalog of blunders." And what's happening in Ukraine is unmitigated disaster. My heart goes out to the people of Ukraine. Ukrainian people remain in my daily prayers. As painful as it is to watch a large country invade and trample a sovereign nation, I don't think we should be surprised by this. Harry Truman said, "There is nothing new in this world except the history that we do not know." But your question is about how this is affecting the investment process. It's actually not affecting the process at all. My investment criteria remains the same, and I remain committed to getting an affirmative answer to the following 4 questions. Is it a business that I can understand? Is it a quality business with sustainable competitive advantage? Is it run by honest, competent management team with skin in the game? And finally, is it available at a reasonable valuation? That investment criteria continues to remain the same in spite of all the volatility and inflation fears and everything that's been happening recently. Perhaps the question can also be expanded a little bit to see if the investment landscape has changed. Yes, the landscape always keeps changing, evolving. With war in Europe, the fear is palpable and the markets have been weak. Even before the war started, the markets had become a little weaker, primarily driven by inflation fears. But I'd like to show a couple of charts here with respect to what's happening more recently.
Sure.
Let me share this here. The first is a chart. This is a list of major geopolitical events going all the way back to Pearl Harbor and how the markets, primarily defined by S&P 500, have behaved a month, a year, and 3 years later. And as you can see, 1941, Pearl Harbor, a month later, S&P was down by 0.3%. But then over 3 years, if you focus on that column, every major geopolitical event has essentially sort of washed off over time. Obviously, I'm just making an observation. I'm not necessarily suggesting anything other than the fact that this is what has happened, and history is a relatively decent guide in this regard.
Certainly, understood.
The other point I wanted to make is since reaching a high on January 3rd, for example, January 3rd of 22, S&P has hit correction territory. Essentially means that it's fallen by more than 10%. As I mentioned, early on, it was driven primarily by inflation fears and potential interest rate increase and macro factors associated with that. So the second chart I wanted to share with respect to that is right here. This is a chart. I'm sorry, this is a little dense, but bear with me for a second. I'll walk you through it. This is a chart that goes all the way back to 1980, lays out, again, S&P 500, which is just the market. The red dots in the bottom half of the chart essentially shows how much during the year S&P 500 declined by. And then the black bars are the positive returns at the end of the year. The key here is, despite an average drop of about 14% intra-year, the market still ended up positive in 32 out of the last 42 years. That's more than 3/4 of the number of years. Again, I'm just making an observation. It's not a prediction. This is early March, and I'm still optimistic that we will find a solution to this Ukrainian issue, and we'll get back to worrying more about some of the regular macro factors like inflation and interest rate.
Sure.
That's, of course, a view on the market. I'll address the portfolio related questions later.
Sure. Yeah. Well, I've heard you say many times, cannot time the markets. You can only try to understand them. And so thanks for those insights. And yeah, as you said, that's a great place to start. That's a great macro picture that you're providing. Let's get a little bit more micro with more than half of SVN's portfolio in European markets. Can you speak to the impact you're seeing right now from the war in Ukraine, and then maybe some of the longer term observations you have to share?
Yeah, we have about 50% of the portfolio in Europe. Specifically, our investments are in Poland. I'll come back to that in a second. Sweden, and Italy. In addition, we also have an investment in Israel. By the way, we do not have any investments in Russia or Ukraine or even China or Hong Kong or Taiwan, for that matter. These all happen to be some of the hot spots at this point. I just wanted to make sure that we are a global investor, but we're not in any of those countries. Before highlighting the specifics with respect to Poland, or maybe any one specific country, let me highlight a couple of other points. While I invest globally, I overlay a few constraints, self-imposed constraints, when I consider opportunities outside the US. I look for opportunities in countries and companies that follow specific accounting regulation called IFRS, International Financial Reporting Standards. Number two, countries that have IP and governance laws that are comparable to the West. So this condition eliminates Russia, China, and many other emerging markets. Number three, companies that file their financials in English. This so far has kept me away from Japan, a market that I think is attractive, but have not found a way yet. So while these self-imposed constraints may look onerous at certain times, I think they also protect us from stepping into landmines. While much of Europe is on the edge because of this war, Eastern Europe is more so, and particularly Poland is visibly shaken. I've had conversations with friends and management teams, and it's evident that even though Poland is part of NATO, which has the implicit protection of the West, Poles are just visibly shaken by what's happening on their borders. Let me bring it back to the portfolio, both in Europe and in the US. Some of the quality businesses that I had been interested in have become more attractive from a valuation standpoint. I'm closely monitoring them, but have not been able to pull the trigger yet. I have been able to pull the trigger on one of the US names which I will write about and talk about later on in the year. But the opportunity set remains fairly interesting and robust.
Wonderful. So given that discussion and kind of those high level thoughts, what would you today say to the trepid investor? What, in light of war, in light of inflation, in light of a looming recession, I think there are a couple of anxiety points that folks might feel. Where do you fall?
A tongue-in-cheek response would be intrepid, but that obviously doesn't answer the thrust, the crux of the question. Having talked about the market earlier, S&P 500 is the backdrop. I'll try and answer this question with, say, our portfolio is the backdrop. First, we own highly profitable companies that are either the most dominant player or one of the most dominant players in their respective space. We do not own any of these money-losing, cash-burning technology companies. 8 of the 11 portfolio companies have announced earnings so far. Some of them are year-end 2021 results, while others are mid-year results, since they have a different fiscal year end. One of the companies I'm waiting on is Dino Polska, which is a Polish grocery chain that focuses on small towns and villages of Poland. As of this morning, I hear that more than 1 million Ukrainians have crossed borders, many of them into Poland, into Eastern Poland, an area where Dino Polska is planning on growing its footprint. I'll wait and watch as to what the next 12 months entails, but I'm very optimistic about the opportunity for a company like Dino Polska, which is a dominant player in that space. But generally, results have been strong to outstanding. Of course, that's just historical performance. What we need is how they will do in the future. Let me take a very specific example of one of our companies and address this question. The largest position in the portfolio is Evolution. It's a Swedish live casino gaming company that caters to operators around the world. This company, I've written about this extensively and discussed this in the past, so I will refrain from going back into the details of the business itself. But just a couple of highlights. The company had been doubling in size every 2.5 years or so. But based on the most recent quarterly results, it has doubled over the last 18 months. I'm referring to size, doubling in size in terms of cash generation, which is what ultimately determines the value of a business. Management is very optimistic about its growth prospects, particularly here in North America. As the company continues to execute its growth strategy, for example, it's releasing 90 new games this year in 2022. They've already released 25 or so. And it's generating this kind of growth while keeping its margins at north of 70%. Think about that. For every dollar of revenue, north of 70 cents is their margin. That's an incredible level of profitability that I have not seen in many businesses. And this company is growing at, as I said, it's essentially doubled over the last 18 months and still has opportunity to grow at a similar pace in the future. The stock, for a variety of different reasons, has not necessarily performed as expected, but I'm very optimistic about its future because of all those factors. Significant growth, high margin, clean balance sheet. There is no debt on the balance sheet, owner-operator company. And in fact, the valuations have come in quite a bit and is looking a lot more optimistic. So that's just one example from our portfolio. I can go name by name to highlight why each one is attractive. And I continue to remain very optimistic.
Fantastic. Great. So switching gears just a little bit, could you discuss some of the investments that you maybe studied in the past year, but passed on? And are there any kind of commonalities, be they market, be they industry, anything like that?
Yeah, that's a very important, very relevant question, I think. I actually went back to my journal that I maintain and went through the number of companies that I have looked at just in the past 1 year. I've actually looked at 47 different businesses in 2021 alone. Some of them in detail, and many others just not quite that much in depth. One company, for example, that I did a lot of work on is actually a very high quality property casualty company, insurance company in Mexico. Another one is a good sized Australian asset management company. I don't think there is, I know, perhaps I can say that there are, 2 or 3 different areas that some of the reasons why I passed on them fall into. One, for example, with respect to this Mexican property casualty company is FX issues. While I run a global portfolio, I do not hedge our positions, not even the FX risk. With Mexican peso and some of the emerging market currencies, I fear the impact of making money in local currency terms, but losing it on foreign exchange. So I'm constantly worried about that. And, that's one of the reasons why I have set that aside. Another good example, as in that same category, is a fantastic retailer in Turkey. It's a great business founded and run by a family, but the Turkish lira has depreciated by about 50% in just 1 year. So that's one bucket. The other bucket is, for example, customer concentration with that Australian asset manager, a phenomenal business. Until recently, it was run by one of the founders. He's been a big beneficiary of what they call as their pension program as super, and it truly is. This asset manager has been performing well, but it had a large client concentration. That was another reason why I passed on that kind of an opportunity. And the third category is just competition. I looked at a number of payment technology businesses and passed on them because of intense competition in that space. So no one specific reason, but those are the general categories.
Sure. Thank you. So another question came in pertaining to kind of your overall analysis and decision-making process. How do you specifically analyze the risk of capital raises, and how do you weigh the trade-off between low entry price and risk of dilution?
Yeah, I think that's an interesting question as well. I laid out the 4 questions that I'm looking for an affirmative answer on. And the second of those 4 questions is the quality of the business. Is it a high quality business with sustainable competitive advantage? The term quality is an important one in that question. While I look at both the quantitative and qualitative angle, let me just use the quantitative part of it to answer this. Now, businesses that I'm generally interested in are not only highly profitable, but they are also run with fortress balance sheet and are self-funding. Let me try and unpack that a little bit. These are businesses that have little to no debt, and so they have very low financial leverage, making them fortress balance sheet. Our portfolio companies and the ones that I'm interested in do not rely on their ability to access outside capital. So, these businesses, they generate enough cash on their own to execute on their strategy, be it acquisition or reinvestment or whatever that may be. So, for example, real estate investment trusts by definition, they are required to return more than 90% of their earnings. So they're constantly looking for outside capital to grow. That's a space that I'm not interested in. So these are self-funding mechanisms that the businesses that I'm interested in. And so that avoids the capital raise question. But perhaps the questioner also is referring to companies issuing stock for acquisitions, or maybe giving away more stock for executives and issues like that. I think that's a real threat. Evolution, for example, has issued stock for 3 of its recent acquisitions, and both I and a few other shareholders that I know have expressed our displeasure to the management team. This is essentially a Swedish company owned mostly by Swedes that's now transitioning to a Swedish company that's now owned mostly by Americans. And so they're hearing from the American investor base, and they're constantly learning the process of capital management. While that dilution is a little bit of a ding in the short to medium term, I think in spite of that, the company has been generating phenomenal returns and is positioned well. And that's the reason why I continue to remain invested in it. But I think it's a very relevant question. It's an item that I constantly watch. And in fact, on the quantitative analysis, I look more at the per share metrics as opposed to the aggregate metric. A company can issue a lot of stock and the numbers can just, balloon up, looking like significant growth and high returns. But when you actually break it down on a per share basis, you get the true picture of the underlying business. That's what I rely on for the quantitative aspect.
Right. Well, then let's end on a lighter note, if we will. Shree, you are a voracious reader, and I would love to know, and I'm sure our audience would love to know, do you have any good books to recommend, investment focused or otherwise?
Yeah, I do read a lot in this time of, geopolitical issue. I would highly recommend a non-investment related book that's more appropriate for this current situation. The title is Why Don't We Learn from History, by a former British soldier and military historian, B.H. Little Hart, H-A-R-T. The book is about the history of wars, but it also provides sort of a psychological pattern of people who start them. It's a grim recapture of human suffering, but it does provide a positive view after all. He says, a long historical view not only helps us to keep calm in a time of trouble, but also reminds us that there is an end to the longest tunnel. Fantastic book. So, yeah.
Well, thank you. I always love your recommendations. So I will look forward to turning a couple pages.
Absolutely.
Well, thank you very much for this time. To our audience, we look forward to providing more of these opportunities to respond to questions. As and when there are some, please do not hesitate to reach out. I can, of course, be reached at jessica@svncapital.com. And, as Shree is always available to respond to. But we look forward to kind of doing these types of update opportunities a little more frequently in the future. Thank you, Shree.
Thank you.